how to make. Money in Stocks, A Beginner's Guide to Profitable Investing. Bonus inside. Robert Cobbs, Author's Contact, Bookminds. Independently published copyright 2024 Robert Cobbs. Introduction. Welcome to How to Make Money in Stocks, A Beginner's Guide to Profitable Investing. If you're reading this, you've already taken the first step toward a brighter financial future. Maybe you're hoping to build wealth, secure your retirement, or simply learn how to navigate the exciting world of stock investing. You're in the right place. Investing in stocks can seem daunting at first. The markets are vast, filled with complex terminology, fluctuating prices, and seemingly endless choices. It's easy to feel overwhelmed and uncertain. But here's the truth. Anyone can learn how to invest successfully. The key is to start with the right foundation, one that empowers you to make informed decisions and navigate the ups and downs with confidence. The stock market has created some of the wealthiest individuals in history, but it's not just for the elite or the financially savvy. It's for anyone willing to take the time to understand its principles and strategies. In this book, we'll break down the fundamentals of investing in a simple, step-by-step way that's perfect for beginners. You don't need to be an expert or have vast sums of money to start. All you need is curiosity, a willingness to learn, and a commitment to sticking with it. By the end of this guide, you'll not only understand how stocks work, but you'll also have the knowledge to begin building your own investment portfolio. You'll learn how to pick the right stocks, assess market trends, and manage your risks, all while keeping a long-term perspective that will serve you well for years to come. Remember, the journey of investing is a marathon, not a sprint. With patience, discipline, and the right mindset, you can unlock the power of the stock market and take control of your financial destiny. Let's get started. Chapter 1. Introduction to Stock Market Investing. Welcome to the world of stock market investing, where the potential to grow your wealth is only limited by your knowledge and patience. As a beginner, it's easy to feel overwhelmed by the unfamiliar terms and the fast-paced nature of the stock market. But trust me, this journey is entirely within your reach. In this introductory chapter, we'll take a step-by-step approach to understanding the basics of the stock market, demystifying the key terms you'll need to know, and explaining why investing in stocks can be one of the best decisions you'll ever make. Understanding the basics of stocks and the stock market. At its core, the stock market is a marketplace where people buy and sell pieces of ownership in companies. These ownership pieces are called shares or stocks. When you buy a share of a company, you essentially own a small portion of it, which means you share in its successes. For example, if you buy a share of a well-known company like Apple, you're technically a part owner, and as the company grows and profits, your investment may grow as well. The stock market is crucial because it provides companies with a way to raise money for growth, expansion, or new projects by selling shares to the public. On the flip side, it gives investors like you an opportunity to buy into these companies and benefit from their success. Whether you're looking to invest for long-term growth, dividend income, or even short-term gains, the stock market offers a variety of opportunities. Key terminology every beginner should know. Before you start investing, it's essential to understand some basic terms that will come up frequently. Shares, stocks, these represent ownership in a company. When you buy a share, you own a small portion of that company. Dividends. Some companies share their profits with shareholders through dividends. If you hold shares in a company that pays dividends, you can earn a regular payout, usually quarterly. Exchanges. The stock market is made up of various exchanges, such as the New York Stock Exchange or NASDAQ, where stocks are bought and sold. These exchanges are the platforms where trading takes place. Brokers. To buy or sell stocks, you need a broker, either a traditional one or an online platform. They facilitate your transactions in exchange for a fee or commission. Market price, the current price of a stock, which changes based on supply and demand. If many people want to buy a stock, its price will rise. If there's little demand, the price may fall. Capital gains, if you sell a stock for more than you paid for it, the profit is called a capital gain. This is one way you can make money in the stock market. Bear market, a market in which stock prices are falling or are expected to fall. Bull market, a market in which stock prices are rising or are expected to rise, the importance of investing and building wealth. Now that you have a basic understanding of stocks, you might be wondering why investing is so important. Simply put, investing is the key to growing your wealth over time. While saving money in a bank account or under your mattress might keep it safe, inflation gradually erodes its value. The stock market offers a way to make your money work for you. Historically, the stock market has outpaced other forms of investment, such as bonds or savings accounts, in terms of returns. For example, the long-term average annual return of the S&P 500, which tracks the 500 largest publicly traded companies in the U.S., has been around 7 to 10%. This means that with steady investment over time, your money can grow significantly. How investing in stocks works. When you invest in stocks, you're essentially betting on the future success of the companies you choose to buy. The value of your stocks will rise and fall based on the company's performance, overall market conditions, and economic factors. For example, if a company releases a breakthrough product or reports strong profits, the stock price may rise. Conversely, if the company faces challenges like poor earnings or a scandal, the stock price may decline. One of the biggest advantages of investing in stocks is that your money has the potential to compound. This means that the returns you earn on your investments can start to earn their own returns over time, helping you build wealth faster. By reinvesting dividends and holding on to your stocks for the long term, you benefit from the power of compounding. Common misconceptions and myths about the stock market. There are many misconceptions about the stock market that can keep beginners from getting started. One common myth is that the stock market is too risky for regular people to invest in. While it's true that the market can be volatile in the short term, history shows that the stock market tends to grow over the long term. In fact, the longer you stay invested, the more time your investments have to recover from downturns and grow in value. Another myth is that you need a lot of money to start investing. The truth is, many brokers allow you to invest with as little as a few dollars, especially with fractional shares. You don't need to be a millionaire to begin building your wealth in the stock market. Finally, many people believe that investing is all about picking the perfect stocks or timing the market. While researching companies and choosing the right stocks is important, successful investing is more about consistency, patience, and long-term strategy. Trying to time the market or pick the next big winner is a risky game and often leads to disappointment. Now that you have a solid understanding of what stocks are, how they work, and some of the myths surrounding them, you're ready to begin your journey toward profitable investing. The stock market is not as intimidating as it seems, and with the right mindset and a commitment to learning, you can navigate it with confidence. In the subsequent chapters, we'll dive deeper into how to create a winning investment strategy and build a portfolio that fits your financial goals. Chapter 2: The Fundamentals of Stock Market Operations. Understanding how the stock market operates is the key to becoming a confident and informed investor. When you buy a stock, you're not just casually picking up a piece of paper, you're engaging in a well-structured system that involves exchanges, brokers, orders, and market makers. This chapter aims to break down these concepts in a way that's both practical and personal, helping you understand the behind-the-scenes mechanics of stock trading, stock exchanges, NYSE, NASDAQ, and others. At the heart of the stock market are exchanges, which are the venues where stocks are bought and sold. Think of exchanges as the marketplaces where buyers and sellers meet. Two of the most well-known stock exchanges are the New York Stock Exchange and NASDAQ, but there are others around the world such as the London Stock Exchange and Tokyo Stock Exchange. The New York Stock Exchange is the world's largest stock exchange by market capitalization. It's where some of the biggest, most established companies are listed, such as Coca-Cola, IBM, and ExxonMobil. The NYSE operates as a physical exchange, with traders buying and selling stocks in a building in downtown Manhattan. NASDAQ, on the other hand, is a completely electronic exchange. It's home to many technology-focused companies, such as Apple, Microsoft, and Tesla. NASDAQ is known for its rapid growth and its focus on innovative, high-tech companies. While these two exchanges are the most famous, there are many others around the world, each playing a crucial role in global investing. But whether you're buying a stock from the NYSE or NASDAQ, The process of trading remains largely the same. How stocks are traded, brokers, online platforms, and apps. In order to buy or sell stocks, you need to go through a broker. A broker is essentially an intermediary who executes your stock trades on the exchange. In the past, this meant calling a stockbroker on the phone or going to their office. But today, thanks to the rise of technology, most people use online platforms and apps to trade stocks. For example, platforms like E-Trade, Fidelity, and TD Ameritrade provide an easy-to-use interface where you can search for stocks, place orders, and monitor your investments. More recently, apps like Robinhood and Webull have become popular because they offer commission-free trading, making investing more accessible to everyday people. These platforms and apps offer several features beyond just trading stocks. They provide tools to research companies, track market news, and manage your portfolio. While they make investing easier, they also come with the responsibility of ensuring you understand what you're doing. Before placing any trades, it's essential to learn about the types of orders you can make. Market orders against limit orders against stop orders. When you buy or sell stocks, you'll encounter three main types of orders: market orders, limit orders, and stop orders. Understanding how these work will help you make smarter decisions when placing your trades. Market orders. A market order is the simplest type of order. When you place a market order, you're instructing your broker to buy or sell a stock at the best available price in the market. This means your order will be executed immediately, but the price you pay or receive might be slightly different from what you saw when you placed the order, especially in a fast-moving market. Market orders are great when you want to buy or sell immediately and are less concerned with the exact price. Limit orders, a limit order, on the other hand, is an order to buy or sell a stock at a specific price or better. For example, if a stock is trading at $100 and you only want to buy it at $95, you can place a limit order at $95. Your order will only be executed if the stock price drops to $95 or lower. Limit orders give you more control over the price at which you buy or sell, but there's no guarantee that your order will be filled if the stock doesn't reach your desired price. Stop orders. A stop order is used to limit losses or protect profits. For instance, if you buy a stock at $50 and you don't want to lose more than $10, you can set a stop order to sell the stock if it drops to $40. Stop orders are often used as a form of risk management, ensuring that your losses don't get too large. The role of market makers and liquidity. You might wonder how stock transactions happen so smoothly, even when millions of shares are being traded every minute. This is where market makers and liquidity come into play. Market makers are firms or individuals who facilitate the buying and selling of stocks by being ready to buy or sell at publicly quoted prices. They act as middlemen between buyers and sellers, ensuring that there's always someone on the other side of the trade. Market makers are crucial because they provide liquidity, the ease with which a stock can be bought or sold without affecting its price too much. High liquidity means there are many buyers and sellers in the market, so it's easy to get in and out of positions. Stocks with high liquidity tend to have smaller price fluctuations, making them safer and more predictable investments. On the other hand, stocks with low liquidity can experience larger price swings, making them riskier. Types of stock markets, primary and secondary markets. Finally, it's important to understand the difference between the primary market and the secondary market. These are the two main types of markets where stocks are traded. Primary market. The primary market is where stocks are initially offered to the public through an initial public offering. When a company first goes public and sells shares for the first time, it's in the primary market. After the IPO, the company receives the funds from the sale, and those who buy shares can later trade them in the secondary market. Secondary market. After stocks are sold in the primary market, they move to the secondary market, which is where most trading occurs. The secondary market is where investors buy and sell shares among themselves. The company whose stock is being traded in the secondary market doesn't receive any money from these transactions. This money goes to the investor selling the stock. Understanding how the stock market operates is essential to becoming a successful investor. From knowing the key exchanges like the NYSE and NASDAQ to understanding how orders work and the role of market makers, this knowledge will empower you to navigate the stock market with confidence. As you dive deeper into investing, keep these fundamentals in mind. They'll help you make smarter decisions and avoid unnecessary confusion. Chapter 3: Types of Stocks and Investment Strategies. When you first venture into the stock market, one of the most important decisions you'll make is choosing the types of stocks you want to invest in. With thousands of companies listed on the market, it's crucial to understand the different categories and how each type aligns with your financial goals, risk tolerance, and investment strategy. This chapter breaks down the various types of stocks and explains essential strategies that will help you build a solid foundation for your investing journey. Different types of stocks, common against preferred stocks. At the most basic level, stocks can be divided into two main types: common stocks and preferred stocks. Common stocks. When you buy common stock, you're buying a share of ownership in a company. As a common shareholder, you have voting rights in major company decisions, such as electing the board of directors or approving mergers. However, your returns are tied to the company's performance, and if the company struggles or goes bankrupt, you're among the last to get paid. Despite the risks, common stocks offer the potential for higher returns, especially if the company grows and the stock price increases. Preferred stocks. Preferred stock is a type of stock that generally doesn't offer voting rights but provides a fixed dividend, which is paid out before any dividends to common shareholders. If the company goes bankrupt, preferred shareholders have priority over common shareholders when it comes to receiving their share of the remaining assets. While preferred stocks tend to offer lower potential for price growth compared to common stocks, they can provide more stability, particularly in terms of income through regular dividends. This makes them appealing to investors who prioritize income over growth. Growth stocks against value stocks. Another important distinction to understand is between growth stocks and value stocks. Each represents a different approach to investing, and the right choice depends on your goals. Growth stocks belong to companies that are expected to grow faster than the overall market. These companies usually reinvest their profits back into the business to fuel further growth, so they often don't pay dividends. Investors buy growth stocks in anticipation of future price appreciation, hoping that as the company expands, the stock price will increase significantly. Examples of growth stocks include tech companies like Amazon or Tesla. The risk with growth stocks is that they can be volatile, especially if the company's growth story falters or market conditions change. Value stocks, on the other hand, are stocks of companies that are currently undervalued compared to their intrinsic worth, often due to short-term setbacks or market misperceptions. These stocks are typically considered more stable and may pay dividends, providing income to investors while they wait for the stock price to rise. Investors in value stocks are essentially betting that the market has overreacted to a company's temporary troubles, and that the stock's price will eventually return to its true value. Examples might include companies like Johnson & Johnson or Warren Buffett's Berkshire Hathaway, which have consistently provided stable growth over time. Dividend-paying stocks against non-dividend stocks. The next distinction to make when considering stocks is whether to focus on dividend-paying stocks or non-dividend stocks. Dividend-paying stocks. These stocks are particularly appealing to investors seeking regular income. When you invest in dividend-paying stocks, you receive a portion of the company's profits in the form of dividends, typically paid quarterly. These dividends can be reinvested to buy more shares, allowing your investment to grow over time. Dividend-paying stocks are often from well-established companies in stable industries like utilities or consumer goods. For example, Coca-Cola and Procter & Gamble are known for their reliable dividend payouts. This strategy works well for investors looking for passive income, such as retirees or those who prefer a steadier, less risky investment. Non-dividend stocks. Non-dividend stocks, by contrast, are companies that reinvest their earnings back into the business rather than paying them out to shareholders. Growth stocks are often non-dividend stocks, as companies focus on expanding their business rather than paying out cash. For investors looking for capital appreciation, these stocks can be more appealing, especially if the company is in a high-growth industry like technology or biotech. While non-dividend stocks can offer high returns, they come with the risk that the company's growth could slow down or even stall. Small cap, mid cap, and large cap stocks. Another key consideration is the size of the companies you want to invest in. Stocks are often categorized based on market capitalization, which is the total value of a company's outstanding shares of stock. The categories are small cap, mid cap, and large cap stocks. Small cap stocks belong to smaller companies with a market capitalization typically under $2 billion. These stocks can offer high growth potential, as small companies have more room to expand. However, they are also riskier and more volatile, often affected by market fluctuations and economic downturns. Investing in small cap stocks can be exciting, but it requires a higher risk tolerance and a long-term outlook. Mid-cap stocks represent companies with market caps between $2 billion and $10 billion. These companies are generally more established than small cap companies, but still have significant growth potential. Mid-cap stocks often strike a balance between risk and reward, offering the potential for both capital appreciation and stability. Large cap stocks are the biggest companies in the market, with market caps over $10 billion. These stocks are generally considered safer investments due to their established track record and financial stability. They tend to offer steady growth, but their upside potential is often more limited compared to small or mid-cap stocks. Large cap stocks often pay dividends, making them attractive to income-focused investors. The concept of diversification and risk management. One of the most powerful strategies you can use as an investor is diversification. Diversification means spreading your investments across different types of stocks to reduce the risk of a large loss. By holding a mix of growth, value, small cap, mid cap, and large cap stocks, you create a portfolio that can weather various market conditions. The idea is simple. If one investment performs poorly, the others may do well, balancing out the overall performance of your portfolio. For example, during a market downturn, small cap stocks may suffer, but large cap dividend stocks might remain stable and continue to pay you income. The goal of diversification is not to eliminate risk entirely, but to manage it in a way that protects your portfolio from significant losses while still offering the opportunity for growth. Alongside diversification, risk management is critical. This involves understanding your own risk tolerance, how much risk you're willing to take on, and adjusting your portfolio accordingly. If you're younger and have a longer time horizon, you might be more inclined to invest in growth stocks or small cap companies. But if you're closer to retirement, you may prefer a more conservative portfolio with large cap or dividend-paying stocks. By understanding the different types of stocks and investment strategies available, you're in a better position to make informed choices that align with your goals. Either you're drawn to the potential for growth through small cap stocks or the stability of dividend-paying large cap companies. The key is to build a portfolio that reflects your risk tolerance, time horizon, and financial objectives. Chapter 4. Understanding stock valuation. As you embark on your investment journey, one of the most crucial steps is learning how to evaluate stocks. Buying shares in a company isn't just about picking a name you recognize or jumping on the latest trend. It's about understanding the value of the company and whether its stock price accurately reflects that value. This chapter will help you navigate the essential metrics and tools that investors use to assess stocks, so you can make informed decisions and invest with confidence. Key metrics to evaluate stocks: P/E ratio, EPS, dividend yield. To start, you need to understand some of the fundamental metrics that investors use to evaluate stocks. These are tools that give you a snapshot of a company's performance, profitability, and overall value. P/E ratio. The P/E ratio is one of the most widely used metrics for assessing a stock's valuation. It compares a company's stock price to its earnings per share. In simple terms, the P/E ratio tells you how much investors are willing to pay for each dollar of the company's earnings. A high P/E ratio could mean that the stock is overvalued, or it could indicate high growth expectations. Conversely, a low P/E ratio might suggest that the stock is undervalued or that the company is struggling. For example, a company with a P/E ratio of 20 means investors are willing to pay $20 for every one of earnings. If the company's earnings grow, the P/E ratio could decrease, making the stock appear more attractive. However, If the company's earnings stagnate, the P/E ratio might indicate that the stock is overpriced. EPS. EPS is a direct measure of a company's profitability. It's calculated by dividing the company's net income by the number of outstanding shares. A higher EPS generally signals that the company is doing well and is able to generate profits for its shareholders. Investors often look for companies with consistently growing EPS, as it can indicate a well-managed business that's increasing its earnings over time. Dividend yield. For investors looking for income in addition to capital appreciation, dividend yield is an important metric. It represents the percentage of a company's stock price that it pays out as a dividend to shareholders. For example, if a company's stock is priced at $100 and it pays a $4 dividend, the dividend yield is 4%. Companies with high dividend yields can be especially attractive for those looking for passive income, though it's important to assess whether the company can sustain these payments. How to analyze company financials, balance sheet, income statement, cash flow. Understanding a company's financial health is critical when evaluating its stock. To do this, you need to look at 3 key financial statements: the balance sheet, the income statement, and the cash flow statement. Balance sheet. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It tells you what the company owns and what it owes. The difference between these two is the company's equity, which represents the shareholders' ownership in the business. A strong balance sheet with more assets than liabilities suggests financial stability, which can be a good sign for investors. However, a company with too much debt could be riskier, especially in times of economic uncertainty. Income statement. The income statement shows the company's revenue, expenses, and profits over a period, usually a quarter or a year. It's essentially a report card on how well the company is performing. Investors focus on the net income line to see if the company is profitable, and they also pay attention to revenue growth. Company with steadily increasing revenue and a healthy profit margin is generally considered to be in good shape. Cash flow statement. The cash flow statement shows how money is flowing in and out of the company. It is divided into 3 sections: operating activities, investing activities, and financing activities. While the income statement shows profits, the cash flow statement is more revealing because it shows how much actual cash the company has on hand. A company can be profitable on paper but struggle if it doesn't have enough cash to cover its operations or pay its debts. Positive cash flow is crucial for a company's long-term survival and growth. The role of analysts and ratings. Analysts play an important role in evaluating stocks. They conduct deep research on companies and industries, providing insights and recommendations for investors. Analysts typically assign ratings to stocks, such as buy, hold, or sell, based on their assessments of the company's fundamentals and future prospects. However, it's important to approach these ratings with caution. Analysts' opinions can vary, and they might have their own biases or agendas. It's wise to combine analyst recommendations with your own research and understanding of the company. After all, you know your financial goals and risk tolerance better than anyone. Additionally, reading analysts' reports can help you spot trends and identify potential risks that you might not have considered. While it's helpful to listen to experts, remember that investing is ultimately about making your own informed decisions. The importance of understanding market trends and economic factors. Finally, understanding broader market trends and economic factors is essential for successful stock evaluation. The stock market doesn't exist in a vacuum. Economic conditions, industry trends, and geopolitical events can all impact stock prices. For example, interest rates set by central banks, such as the Federal Reserve, have a direct influence on the cost of borrowing and, consequently, corporate profitability. If interest rates rise, it could hurt companies that rely on borrowing for growth, making their stocks less attractive. In addition to economic factors, you'll need to consider broader market trends, such as shifts in consumer behavior or technological advancements. For instance, the rise of electric vehicles has driven stock growth in companies like Tesla, while the expansion of cloud computing has benefited tech giants like Amazon and Microsoft. By staying informed about the industries you're invested in, you can spot trends early and adjust your portfolio accordingly. Putting it all together. Evaluating stocks is both an art and a science. By looking at key metrics like P/E ratio, EPs, and dividend yield, you can get a sense of whether a stock is a good value. Analyzing a company's financials gives you a deeper understanding of its profitability and financial health, while paying attention to analysts' ratings and market trends helps you stay ahead of the curve. Ultimately, investing in stocks is about making informed decisions based on your research and your goals. By combining these tools and techniques, you'll be better equipped to choose stocks that align with your investment strategy, minimize risk, and potentially maximize returns. Chapter 5: Setting Your Investment Goals and Risk Tolerance. One of the most important steps in becoming a successful investor is understanding your investment goals and risk tolerance. Before you buy a single share, it's crucial to determine what you're trying to achieve with your investments and how much risk you're willing to take. This chapter will help you set clear financial goals and assess your personal risk tolerance, providing the foundation for a strategy that suits your needs and objectives. Determining your financial goals, short-term against long-term investing. The first step is to clearly define your financial goals. Are you looking to make money quickly, or are you planning for the future? There's a significant difference between short-term and long-term investing, and your goals will influence how you approach the stock market. Short-term goals. If you're aiming to achieve financial goals in the near future, perhaps within 1 to 5 years, your investment strategy will likely focus on more conservative investments. For instance, you might want to save for a down payment on a house, build an emergency fund, or fund a child's education. Short-term investing tends to prioritize safety and liquidity, meaning you might avoid high-risk stocks in favor of more stable options, like dividend-paying companies or bonds. Long-term goals, on the other hand, long-term investing typically focuses on goals that are 5 years or more down the road, such as retirement or building wealth over time. With long-term investing, you can afford to take on more risk because you have more time to recover from market volatility. Stocks, particularly growth stocks, become more attractive when you have the time to ride out short-term fluctuations. Long-term goals often require a more patient mindset as you are investing to accumulate wealth over a significant period of time. Understanding risk tolerance, conservative, moderate, and aggressive investors. Every investor has a unique level of risk tolerance, which refers to how much risk you're willing to take on with your investments. Understanding your risk tolerance is essential to shaping your investment strategy. Conservative investors, if you are risk-averse or closer to retirement, you may have a low risk tolerance. Conservative investors tend to prefer safer, more stable investments with lower returns. They might favor bonds, dividend-paying stocks, or large-cap stocks with a proven track record of stability. The focus here is on protecting the value of your portfolio rather than seeking high returns. If you have a low tolerance for market swings and want to avoid the possibility of significant losses, this might be the right approach for you. Moderate investors. A moderate investor is someone who seeks a balance between risk and reward. Moderate investors might allocate their portfolio with a mix of both stocks and bonds, blending growth and income-focused investments. They're comfortable with some volatility in the market and are willing to accept moderate risk in exchange for the potential for higher returns. If you're somewhere in between wanting to protect your capital and growing your wealth, this approach might suit you. Aggressive, comfortable with high levels of risk in exchange for the potential of high returns. This approach typically involves a greater focus on growth stocks, small cap stocks, or emerging markets, which have higher volatility but can also lead to substantial gains over time. If you're young, have a long time horizon, and are willing to handle fluctuations in your portfolio, you may be more inclined to adopt an investors. Aggressive investors are. Aggressive investment strategy. Your risk tolerance is influenced by factors such as your age, income, financial obligations, and emotional comfort with market fluctuations. It's important to assess your risk tolerance honestly and realistically, as it will guide how you structure your investment portfolio. How to assess your financial situation before investing. Before diving into the stock market, it's essential to assess your financial situation. Take a close look at your income, expenses, savings, and existing debt. This evaluation will help you determine how much you can afford to invest and where to direct your funds. Emergency fund. Make sure you have a sufficient emergency fund before you start investing. Financial experts recommend having 3 to 6 months worth of living expenses set aside in case of unexpected circumstances. Investing without an emergency fund can put you in a precarious position if you need cash quickly. Debt management: if you have high interest debt, such as credit card balances, it's generally wise to pay that off before investing heavily. High interest debt can quickly undermine any returns you make on your investments. Monthly cash flow: understanding your monthly cash flow will help you know how much extra money you have available to invest. It's important not to invest money that you might need in the near future for things like bills, rent, or other essential expenses. By assessing your financial situation, you can make informed decisions about how much money to invest and how to balance your investment goals with your current financial needs. The role of asset allocation in managing risk. Once you understand your goals and risk tolerance, the next step is to think about asset allocation, the process of spreading your investments across different asset classes to manage risk. Asset classes include stocks, bonds, real estate, and other investment vehicles. Diversifying your investments across these assets helps reduce the risk of losing money in any one area. For example, if you are an aggressive investor, you might allocate a large portion of your portfolio to stocks, especially growth or small cap stocks. However, if you are a more conservative investor, you may allocate a higher percentage of your portfolio to bonds or dividend-paying stocks, which tend to be less volatile than growth stocks. The key to asset allocation is finding the right mix that aligns with your risk tolerance and investment goals. The importance of starting small and growing your portfolio. As you begin investing, it's important to start small and gradually build your portfolio over time. There's no need to rush into high-stakes investments or overextend yourself financially. Begin by making modest investments that you're comfortable with, and as you gain experience, you can gradually increase your contributions. Starting small allows you to learn and grow as an investor without exposing yourself to too much risk in the beginning. You can start with a well-diversified portfolio, such as exchange-traded funds or index funds, which offer broad exposure to the market and lower risk. Over time, as you become more confident and knowledgeable, you can consider more specialized investments like individual stocks or bonds. Starting small also allows you to make mistakes without risking significant financial harm. Investing is a long-term game, and the goal is to gradually grow your wealth in a controlled, deliberate way. By setting clear investment goals, understanding your risk tolerance, and assessing your financial situation, you're equipped to develop a strategy that works for you. Either you are a conservative, moderate, or aggressive investor, it's important to stay true to your financial objectives and make thoughtful decisions that will help you achieve long-term success. Chapter 6: Building Your First Stock Portfolio. Building your first stock portfolio is an exciting and empowering step in your investment journey. It can feel daunting at first, but with the right approach and strategy, you can confidently begin investing and working towards your financial goals. This chapter will walk you through the process of creating your first portfolio, from choosing the right brokerage account to selecting your first stocks and learning the importance of diversification. Choosing the right brokerage account for beginners. Before you start selecting stocks, the first thing you need to do is choose a brokerage account. Think of a brokerage account as your gateway to the stock market. There are several types of brokerage accounts available, so it's important to select one that fits your needs as a beginner. Online brokerages are typically the most cost-effective and accessible option for beginners. These platforms allow you to trade stocks and other securities through an easy-to-use interface. Popular brokers like Fidelity, Charles Schwab, and TD Ameritrade offer commission-free trades and no account minimums, making them ideal for new investors. Many of these platforms also provide educational resources and customer support to help you get started. Robo-advisors. If you're looking for a hands-off approach to investing, a robo-advisor might be the right choice. Robo-advisors like Betterment or Wealthfront use algorithms to create and manage a diversified portfolio for you based on your risk tolerance and financial goals. While they tend to charge small management fees, they are a great option for people who want to invest without spending a lot of time picking stocks or ETFs. Traditional brokers, if you prefer personalized advice and are willing to pay for it, traditional brokers can offer more tailored services. However, these services typically come with higher fees and commissions, so they are often best suited for investors with more experience or those looking for in-depth guidance. When selecting a brokerage, pay attention to factors like fees, commissions, account types, available research tools, and educational resources. The right account for you will depend on how much involvement you want in managing your investments. How to select stocks for your portfolio. Once you have your brokerage account set up, the next step is to begin selecting stocks for your portfolio. While it can be tempting to pick stocks based on trends or headlines, it's important to approach stock selection thoughtfully. Start by considering factors such as the company's financial health, growth potential, and overall stability. Research the company. Look into the financials of any company you're considering. Pay attention to key metrics like earnings growth, P/E ratio, and debt levels. Read up on the company's leadership and business model. Understanding the company's future prospects can help you determine whether it's a good fit for your portfolio. Understand the industry beyond just looking at individual companies. Take the time to understand the industry they're a part of. For example, if you're looking at tech stocks, research trends in the tech industry. Are companies in cloud computing or electric vehicles expected to grow? Understanding these macro trends can help you choose companies that are poised for future success. The importance of diversification across industries. As you begin selecting stocks, it's crucial to diversify your portfolio. Diversification is one of the most effective ways to reduce risk, and it means spreading your investments across different industries and asset classes. By doing so, you protect your portfolio from downturns in any one sector. For example, if you only invest in tech stocks and the tech sector faces a downturn, your entire portfolio could take a hit. But if you diversify by including stocks from other industries like healthcare, consumer goods, or energy, your portfolio is less likely to be affected by fluctuations in any single sector. Example of diversification: tech, companies like Apple or Microsoft Healthcare, companies like Johnson & Johnson or Pfizer Consumer Goods, companies like Coca-Cola or Procter & Gamble. Energy, companies like ExxonMobil or NextEra Energy. Diversification not only applies to industries, but also to investment vehicles. This brings us to the next point: balancing individual stocks and ETFs. Balancing between individual stocks and ETFs. When building your portfolio, you'll need to strike a balance between investing in individual stocks and exchange-traded funds. Both have their pros and cons, so it's important to know when to use each. Individual stocks. Investing in individual stocks allows you to handpick companies that you believe in and think will perform well. However, it requires more research, and there's higher potential for volatility. If you're a beginner, it's best to start small and invest in stocks you believe have solid long-term growth potential. As your portfolio grows and you become more experienced, you can increase the number of individual stocks you own. ETFs. ETFs are investment funds that hold a basket of stocks or other assets, and they are traded on the stock exchange just like individual stocks. The key advantage of ETFs is that they offer instant diversification since they track entire indexes or sectors. For example, if you invest in an S&P 500 ETF, you're indirectly investing in 500 of the largest publicly traded companies in the U.S., spreading your risk across various sectors. ETFs are a great way for beginners to get broad exposure to the market with relatively lower risk. A balanced portfolio might include a mix of both individual stocks and ETFs, allowing you to capture the potential growth of specific companies while benefiting from the diversification of ETFs. Dollar cost averaging and its benefits. One strategy that can help reduce the emotional stress of investing is dollar cost averaging. DCA involves investing a fixed amount of money into the market at regular intervals, say every month or quarter, regardless of market conditions. The key benefit of DCA is that it helps smooth out the effects of market volatility. By investing regularly, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can help you avoid trying to time the market, which is notoriously difficult. For instance, if you decide to invest $500 every month, in a month when the stock price is low, you'll buy more shares. And in a month when the price is high, you'll buy fewer shares. This strategy reduces the risk of making large investments at the wrong time and encourages a long-term, disciplined approach to investing. Starting your journey. Building your first stock portfolio is a process that takes time and careful planning. By selecting the right brokerage account, researching stocks thoroughly, diversifying your investments, and using strategies like dollar cost averaging, you'll be on your way to constructing a balanced portfolio that reflects your goals and risk tolerance. Remember, investing is a marathon, not a sprint. The more you learn and the more you invest, the more confident you'll become in your decisions. As you continue on this journey, your portfolio will grow and you'll see the fruits of your disciplined, long-term approach to investing. Chapter 7. Analyzing market trends and timing your investments. Understanding market trends and knowing when to invest can significantly impact your success as an investor. However, timing the market is not always as straightforward as it seems. Many beginners feel overwhelmed by the complexity of market cycles, stock charts, and financial reports. But with the right approach, you can make informed decisions and manage your investments effectively. In this chapter, we'll break down essential tools like market cycles, technical and fundamental analysis, and risk management to help you navigate these decisions with confidence. Understanding market cycles, bull and bear markets. The stock market moves in cycles, which can significantly influence your investing strategy. Understanding these cycles is key to knowing when to enter or exit the market. There are two primary types of market cycles, bull markets and bear markets. Bull markets. A bull market is a period when the stock market is rising or expected to rise. During a bull market, investor sentiment is generally positive, and there's optimism about the future. Stock prices typically increase, and companies show strong earnings growth. In a bull market, the key is to stay invested and avoid making rash decisions based on short-term fluctuations. Bull markets can last for years, but it's important to be cautious about getting overly greedy and investing in overly speculative stocks. Bear markets. A bear market is when stock prices are falling or expected to fall. Investor sentiment tends to be negative, and economic conditions may be weaker. These markets can cause panic selling, but they also present opportunities for long-term investors to buy undervalued stocks. During a bear market, it's important to stay calm, reassess your portfolio, and avoid making impulsive decisions. Long-term investors can take advantage of lower prices by focusing on high-quality stocks that will recover over time. Understanding these cycles will help you make smarter decisions about when to buy and sell, keeping in mind that it's often better to stay the course during downturns and make adjustments when markets are in a strong growth phase. Technical analysis, chart patterns, moving averages, and indicators. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. While it may seem complex, it offers practical tools to help you analyze market trends and determine optimal entry and exit points. Chart patterns. Stock charts display historical price movements, which can reveal patterns that repeat over time. Patterns like head and shoulders, triangles, and flags can signal changes in market direction. Understanding these patterns can give you insight into potential market movements. Moving averages. Moving averages smooth out price data to help identify trends over time. Common types include the simple moving average and the exponential moving average. A rising moving average typically indicates an uptrend, while a falling moving average may signal a downtrend. Watching crossovers between short-term and long-term moving averages can provide a clue about the market's direction. Indicators. Various technical indicators, such as Relative Strength Index and MACD, help investors assess whether a stock is overbought or oversold, providing additional context for buy or sell decisions. These indicators are useful for timing investments and can be applied alongside other tools to confirm trends. While technical analysis is often used by traders for short-term decisions, investors can use it to spot opportunities in both short and long-term trends. Fundamental analysis, reading financial reports and company news. On the other side, fundamental analysis involves assessing a company's financial health, prospects, and the broader economic environment. This approach helps you decide whether a stock is undervalued or overvalued based on intrinsic value. Financial reports. Key financial reports include the income statement, balance sheet, and cash flow statement. These documents provide vital information about a company's revenue, profit margins, assets, liabilities, and cash flow. A strong balance sheet and consistent cash flow are signs of a well-managed company, which is important for long-term investors. Company news. Pay attention to industry news, earnings reports, and announcements related to the company you're invested in. For example, news of new product launches. Strategic partnerships or leadership changes can influence stock prices. Similarly, earnings reports can provide a snapshot of a company's financial health, affecting investor sentiment and stock performance. How to time your investments, market conditions, interest rates, and earnings reports. Timing your investments requires a clear understanding of the broader market conditions and how external factors like interest rates and earnings reports influence stock prices. Market conditions. Always consider the overall health of the economy when making investment decisions. During economic expansions, stocks tend to perform well, while during recessions, stocks may underperform. Knowing whether we're in a growth phase or heading into a downturn helps you adjust your portfolio to match the economic climate. Interest rates. Interest rates set by central banks have a profound impact on the stock market. When interest rates are low, borrowing becomes cheaper, leading to increased consumer spending and business investment. This is generally good for stocks. On the other hand, rising interest rates can increase borrowing costs, potentially slowing down economic growth and negatively affecting stock prices. Earnings reports. Companies report their earnings quarterly, and these reports often move stock prices. If a company reports better than expected earnings, the stock price can surge. If the earnings fall short of expectations, the stock price may drop. Keeping an eye on earnings reports can help you assess whether a company's stock is a good investment. Risk management during volatile times. Market volatility is an inevitable part of investing, and managing risk during these times is essential to protecting your portfolio. Stay calm. It's easy to panic when the market is volatile, but emotional decisions often lead to poor outcomes. Stick to your investment plan, and remember that short-term volatility can provide long-term opportunities for those with a steady hand. Diversify your portfolio. Diversification is one of the most effective strategies to manage risk. By spreading your investments across different sectors, industries, and asset classes, you reduce the risk of significant losses from a single market downturn. Use stop-loss orders. If you're concerned about major losses in a volatile market, consider setting stop-loss orders on your stocks. A stop-loss order automatically sells a stock if its price falls below a specified level, helping limit potential losses. In times of volatility, having a clear risk management strategy ensures that you stay on track toward your long-term goals, even when markets are unpredictable. Analyzing market trends and timing your investments requires a blend of knowledge, patience, and discipline. By understanding market cycles, utilizing technical and fundamental analysis, and managing risk effectively, you'll be better equipped to make informed decisions and build a resilient portfolio. Remember, there's no perfect time to invest, but with the right strategies, you can navigate the ups and downs of the market with confidence. Chapter 8: Monitoring and Managing Your Stock Investments. Once you've built your portfolio and started investing in stocks, the real work begins, actively monitoring and managing your investments. It's not enough to simply buy stocks and wait. By keeping an eye on how your investments are performing, staying informed about market conditions, and knowing when to adjust your portfolio, you'll increase your chances of long-term success. In this chapter, we'll explore practical ways to track your investments, rebalance your portfolio, set up alerts, and make informed decisions about when to buy, sell, and adjust your holdings. How to track your portfolio performance. Tracking your portfolio is a critical part of staying on top of your investments. Fortunately, there are many tools available to help you do this efficiently. Most brokerage platforms provide an online dashboard where you can easily view your portfolio's overall performance, broken down by individual stocks, sectors, and asset classes. This gives you a snapshot of how your investments are doing. To monitor your portfolio's performance effectively, start by reviewing total return, which includes both the change in the value of your investments and any dividends you've earned. For example, if you invested in dividend-paying stocks, the dividends you receive contribute to your total return, adding value to your portfolio beyond just stock price appreciation. Additionally, you should also measure the performance of your portfolio against a benchmark. Common benchmarks like the S&P 500 or the Dow Jones Industrial Average help you see whether your portfolio is outperforming the broader market. Keep in mind that the stock market fluctuates, and short-term performance isn't always indicative of long-term success. Rebalancing your portfolio to maintain diversification. Over time, the allocation of stocks in your portfolio will shift due to changes in stock prices. For instance, if a particular stock or sector has grown significantly, it could now take up a larger portion of your portfolio than you originally intended. This is where rebalancing comes in. Rebalancing involves adjusting your portfolio to ensure it maintains the desired level of diversification and risk. For example, if your portfolio has become too heavily weighted in one sector and underweight in another, you may decide to sell some of your tech stocks and buy more healthcare stocks to get back to your desired allocation. Rebalancing isn't something you need to do constantly. Most investors find it effective to review their portfolio and rebalance on a quarterly or annual basis. However, if one stock or sector experiences an extreme rise or fall, it might be worth rebalancing sooner. The key is to maintain a balance between growth and risk, ensuring that your portfolio remains aligned with your financial goals. Setting up alerts and staying informed on market news. Staying informed is essential when managing your stock investments. Fortunately, technology makes this easier than ever. Most brokerage accounts allow you to set up price alerts for specific stocks. For instance, you can receive an email or notification when a stock you're interested in hits a certain price point, either above or below your target. This feature is valuable for keeping tabs on market fluctuations and enabling you to make timely decisions. In addition to price alerts, it's also important to keep track of company news. A significant development, such as a leadership change, a product launch, or earnings reports, can have a major impact on a stock's price. Staying on top of this news will help you understand why a stock may be moving and whether it aligns with your long-term strategy. Furthermore, subscribing to financial news sources like Bloomberg, CNBC, or Reuters, and following reputable analysts and experts on social media can keep you up to date with market trends and potential investment opportunities. When to sell a stock, identifying underperformance or achieving goals. Knowing when to sell a stock is often one of the hardest decisions for investors. There are two main scenarios when you might consider selling. 1. Underperformance, if a stock or investment isn't performing as expected. It may be time to reassess whether it's worth holding on to. Perhaps the company's fundamentals have changed. Maybe it's losing market share or the management team is facing challenges. Alternatively, the stock might simply not fit your long-term goals anymore. If a company's prospects no longer align with your investment strategy or the stock is persistently underperforming compared to the broader market, it might be time to sell and reallocate the funds elsewhere. 2. Achieving your goals. On the flip side, you might want to sell a stock if it has met or exceeded your investment goals. For example, if you set a price target for a stock and it reaches that level, you could sell and lock in your profits. Alternatively, if a stock has grown so much that it now represents too large a portion of your portfolio, selling some of it and diversifying into other investments might be a wise move. The important thing is to regularly assess your portfolio's alignment with your long-term goals and be willing to make changes when necessary. Tax implications of buying and selling stocks. Before you rush to sell an underperforming stock or lock in profits, it's important to consider the tax implications of buying and selling. In most countries, the profit you make from selling a stock is subject to capital gains tax. The tax rate depends on how long you've held the stock. Short-term capital gains. If you sell a stock within a year of purchasing it, the profit is usually taxed as short-term capital gains, which are typically taxed at a higher rate, equivalent to your ordinary income tax rate. Long-term capital gains. If you hold the stock for over a year before selling, the profit is subject to long-term capital gains tax, which is usually taxed at a lower rate. In addition to capital gains, dividends from stocks may also be taxed, though qualified dividends generally have favorable tax treatment. To minimize taxes, you can consider tax-advantaged accounts like IRAs or 401(k) in the U.S., which allow you to grow investments without paying taxes on capital gains or dividends until you withdraw the funds. Effectively monitoring and managing your stock investments is an ongoing process that involves tracking performance, adjusting your portfolio, staying informed, and understanding when to make changes. By keeping a close eye on your investments and making informed decisions based on market conditions and your financial goals, you can help ensure long-term success. Chapter 9. Advanced strategies for growing your wealth. As you progress in your investing journey, you may begin to look for ways to accelerate your wealth growth beyond traditional buy and hold strategies. While these advanced strategies can be powerful tools for boosting returns, they also come with greater risk and require a deeper understanding of the market. In this chapter, we'll explore advanced strategies such as dividend reinvestment, swing and day trading, options trading, margin trading, and international investing. By understanding these techniques, you can expand your investing toolkit and make more informed decisions. Dividend reinvestment and the power of compounding. One of the most powerful tools for growing your wealth over time is dividend reinvestment. When you invest in dividend-paying stocks, you have the option to reinvest the dividends you receive back into purchasing more shares of the stock. This is known as a dividend reinvestment plan. While it might seem like a small decision at first, this approach can lead to significant wealth accumulation over the long term due to the power of compounding. Compounding occurs when the returns on your investments generate their own returns. By reinvesting dividends, you're effectively buying more shares, which then generate more dividends, leading to a snowball effect. For example, if you invest in a stock with a 3% annual dividend yield and you reinvest those dividends, your investment grows at a faster rate than if you just took the cash. Over time, this effect becomes more pronounced, especially if you're able to stick with a long-term strategy. The key to success with this strategy is patience and consistency. Swing trading and day trading, pros and cons. Swing trading and day trading are active trading strategies that aim to profit from short-term price movements in stocks, often over days or weeks or within the same trading day. These strategies can yield high returns, but they also come with considerable risks and require a solid understanding of market behavior. Swing trading involves buying stocks with the expectation that their price will move in your favor within a few days or weeks. Traders use technical analysis, chart patterns, and indicators to identify price swings and capitalize on these movements. The primary advantage of swing trading is the potential for significant returns without the need to monitor the market minute by minute. However, It requires a deep understanding of market trends and risk management techniques to avoid losses. Swing traders typically aim for a more balanced risk to reward ratio compared to day traders. Day trading is an even more active strategy where stocks are bought and sold within the same day, with positions typically held for minutes to hours. The goal is to exploit small price movements throughout the day. Day trading requires constant attention to the market and is much more time-consuming. The potential for profit is high, but so are the risks. Due to the speed of execution required, day traders often use leverage to amplify their returns, which increases the potential for both gains and losses. While some day traders are very successful, many novice traders find themselves facing significant losses. This is a strategy best suited for experienced traders with a strong grasp of technical analysis and market timing. Options trading, calls, puts, and strategies for beginners. Options trading is an advanced strategy that gives you the right, but not the obligation, to buy or sell a stock at a predetermined price by a specific date. There are two main types of options: call options. A call option gives the buyer the right to buy a stock at a certain price within a set time frame. Investors typically buy call options when they believe the stock price will rise. If the stock price increases above the strike price, the investor can either sell the option for a profit or exercise it to buy the stock at a lower price. Put options. A put option gives the buyer the right to sell a stock at a predetermined price. Investors typically purchase put options when they believe the stock price will decline. If the stock price falls below the strike price, the investor can profit by selling the option or exercising it. Options can be a powerful tool for speculating on stock price movements or hedging against potential losses in your portfolio. However, they can be complex and risky, particularly for beginners. It's important to understand the mechanics of options and to have a clear strategy before engaging in options trading. Beginners might start with simple strategies, such as buying calls or puts, before moving on to more advanced tactics like spreads or straddles. Understanding margin trading and leverage. Margin trading involves borrowing money from your brokerage firm to buy more stocks than you could with just your own capital. This allows you to amplify your potential returns, but it also increases your exposure to risk. When you use leverage in margin trading, you're borrowing funds to control a larger position. For example, if you have $10,000 and borrow an additional $10,000 on margin, you can invest $20,000. If your investment goes up in value, your profits are doubled compared to if you had invested only your own funds. However, if the investment declines in value, your losses are also amplified. While margin trading can lead to higher returns, it also carries the risk of a margin call, a situation where the value of your account falls below a required level, and the broker demands that you deposit more funds or sell some assets. This strategy requires careful risk management and a strong understanding of your tolerance for loss. International investing and emerging markets. International investing is an increasingly popular strategy as investors look beyond domestic markets for growth opportunities by investing in stocks outside of your home country. You can diversify your portfolio and potentially tap into markets with higher growth rates. International investing can be done through individual stocks or international mutual funds and exchange-traded funds. One area of international investing that is gaining attention is emerging markets. These are countries or regions that are still in the early stages of industrial development but have strong growth potential. Examples include countries in Asia, Africa, and parts of Latin America. Investing in emerging markets offers the opportunity to capture higher returns, but it also comes with higher risks, including political instability, currency fluctuations, and economic volatility. Investors interested in international or emerging markets should do thorough research and consider diversifying across multiple regions to mitigate some of the risks involved. Advanced strategies like dividend reinvestment, swing trading, options trading, margin trading, and international investing offer exciting opportunities to accelerate your wealth-building efforts. However, each of these strategies comes with unique risks and requires a deeper understanding of the market. As you consider these advanced approaches, it's crucial to align them with your financial goals, risk tolerance, and level of expertise. Always continue to educate yourself, manage risks wisely, and be patient as you grow your wealth through these strategies. Chapter 10: Common mistakes to avoid and tips for long-term success. Investing in stocks can be an incredibly rewarding way to build wealth, but it's not without its pitfalls. As you grow in your investing journey, you'll inevitably face challenges, and it's important to be aware of the common mistakes that many beginners make. Avoiding these mistakes can help you build a more successful investment strategy and set you on the path toward long-term financial success. In this final chapter, we'll explore the most common investing mistakes and offer practical advice to help you stay disciplined, focused, and on track. Overtrading and emotional investing. One of the biggest traps that new investors fall into is overtrading. This occurs when you trade stocks too frequently, often in response to short-term market movements. Overtrading can be costly in several ways. First, the more often you trade, the more you'll pay in commissions and fees. Second, it often leads to emotional decision-making, where fear or greed pushes you to buy or sell at inopportune times. Emotional investing is driven by reactions to the market, whether that's panic during a market downturn or excitement during a rally. It's essential to stay level-headed when investing. Remember that the stock market is cyclical and short-term volatility is normal. Instead of reacting emotionally to price swings, focus on your long-term goals and strategy. It's not about timing the market, but rather sticking to your plan and allowing your investments to grow over time. Chasing trends and investing in hot tips. Another common mistake is chasing trends or investing based on hot tips from friends, family, or social media influencers. While it can be tempting to jump into stocks that are experiencing a surge in popularity, following trends without doing your own research can be dangerous. The reality is that many of these hot tips are speculative and often lead to losses when the hype dies down. Rather than jumping from one trendy stock to the next, take the time to research companies that align with your financial goals. Focus on long-term value rather than short-term gains. The best investors typically stay away from fads and instead focus on solid, fundamentally strong companies that have sustainable growth potential. Be wary of impulse buys. True wealth building comes from disciplined, thoughtful investing over time. Neglecting proper research and due diligence. One of the most crucial aspects of investing is due diligence. Many investors make the mistake of neglecting research before buying a stock. Whether it's skipping over a company's financial reports, ignoring industry trends, or failing to evaluate the management team, not doing proper research can lead to poor investment choices. Before purchasing any stock, you should take the time to analyze the company's financials, understand the industry it operates in, and evaluate its competitive position in the market. Review key metrics like the price-to-earnings ratio, earnings per share, and dividend yield. Make sure you understand the risks involved and how the stock fits into your overall portfolio. By conducting thorough research, you reduce the chances of making impulsive decisions based on incomplete or misleading information, holding on to losing stocks for too long. It's natural to want to hold on to an investment that's not performing well, hoping that it will eventually rebound. However, holding on to losing stocks for too long can be a detrimental mistake. This is often driven by hope, the hope that the stock will go back up, or the fear of locking in a loss. In reality, sometimes the best decision is to cut your losses and move on to better opportunities. If a stock consistently underperforms or its fundamentals have changed for the worse, it might be time to sell. This doesn't mean that every loss should be cut short, but rather that you need to have a strategy in place to assess when a stock no longer aligns with your goals. Regularly review your portfolio and ask yourself if each stock is still a good fit for your overall investment plan. The key is to avoid the emotional attachment to losing positions, as it can cloud your judgment and prevent you from making more profitable moves. Staying disciplined and patient, investing for the long haul. Investing for the long term requires discipline and patience. One of the biggest mistakes investors make is trying to time the market or make decisions based on short-term fluctuations. The most successful investors understand that stock investing is a long-term commitment, and they maintain discipline throughout the ups and downs. Building wealth through investing takes time. While it may be tempting to seek quick returns, the real magic happens. When you stay committed to your investment plan, continually reinvest dividends, and weather market volatility. The stock market can be volatile in the short term, but over long periods, it has historically produced strong returns. Patience is key. Don't get distracted by market noise and stay focused on your long-term financial goals. The best investors are those who set a plan, stick to it, and remain calm during periods of market uncertainty. This means investing regularly, keeping emotions in check, and making decisions based on facts and research rather than temporary emotions. Avoiding common investing mistakes is essential for achieving long-term financial success. Maybe it's overtrading, chasing trends, neglecting research, holding on to losing stocks, or giving into emotional investing. These pitfalls can derail your investment strategy and prevent you from reaching your goals. By staying disciplined, doing your research, and focusing on the long haul, you'll be better equipped to navigate the ups and downs of the market and grow your wealth over time. Remember, successful investing isn't about making a quick profit. It's about making informed, consistent decisions and staying patient as your investments compound over time. Keep your eyes on your long-term objectives and let time do the work for you. Conclusion: congratulations on completing this guide to stock market investing. You've now gained a solid understanding of the foundational concepts, strategies, and tools that can help you navigate the world of investing with confidence. Maybe you're just starting or have already begun your investment journey. The key to success lies in continuous learning, disciplined execution, and patience. Take note, investing is not a get-rich-quick endeavor. It's a long-term commitment that requires thoughtful planning, research, and a steady approach. By setting clear financial goals, diversifying your portfolio, and staying patient, you can build wealth over time, even in the face of market volatility. Avoiding common mistakes like emotional investing, chasing trends, and neglecting proper research will help you stay on course and make better, more informed decisions. As you continue to grow your investments, keep learning, stay disciplined, and remain focused on your long-term objectives. The stock market offers tremendous opportunities, but it's up to you to seize them with the right mindset. Stay committed, and in time, you'll be well on your way to achieving your financial goals and building a prosperous future through smart, strategic investing. About the book. Are you ready to take control of your financial future but don't know where to start? Stock market investing might seem intimidating, but with the right guidance, it can become a powerful tool for building wealth. How to Make Money in Stocks breaks down complex financial concepts into easy-to-understand steps, making it the perfect resource for beginners. Whether you're looking to create passive income, save for retirement, or simply grow your wealth, this book covers everything you need to know, from the basics of stock valuation to advanced investment strategies. This book offers practical tips, real-life examples, and clear explanations of key terms and concepts that will help you avoid common mistakes and achieve long-term financial success. Don't wait another day to start building your financial future. Get your copy of How to Make Money in Stocks today and take the first step toward becoming a smarter, more successful investor. With this guide in hand, you'll be empowered to make wise investment choices and grow your wealth with confidence. Bonus: here are 25 vital facts about stock investing that can help you understand the essentials and improve your chances of success. 1. Stock ownership means partial ownership in a company. When you buy a share of stock, you become a partial owner of the company, which gives you certain rights, such as voting on company matters in annual meetings. 2. Stocks can offer high returns, but they are risky. Stocks have historically provided higher returns than other investment types, but they come with higher volatility and risk. 3. Stock prices fluctuate due to market forces. Stock prices are determined by supply and demand, influenced by factors like company performance, market sentiment, and global events. 4. Diversification reduces risk. By holding a variety of stocks from different sectors or regions, you reduce the risk that comes with having all your investments tied to one company or industry. 5. There are two main types of stocks, common and preferred. Common stocks give you voting rights and potential dividends. Preferred stocks offer dividends but typically don't provide voting rights. 6. Dividends provide income. Many companies pay dividends to their shareholders, which is a way of sharing profits. Dividend income can be reinvested or used as passive income. 7. Stock market is a long-term investment. While you can trade stocks short-term, successful investing usually requires patience. Historically, the stock market tends to grow over the long term despite short-term volatility. 8. The stock market is highly liquid. Stocks are generally easy to buy and sell, making them more liquid than other forms of investments like real estate or private equity. 9. Brokers facilitate stock transactions. To buy and sell stocks, you need to go through a brokerage, whether a traditional broker or an online platform like Robinhood or E-Trade. 10. Stock investing is accessible to anyone. With the rise of online brokers and apps, it's easier than ever for anyone, even beginners with small amounts of capital, to start investing in stocks. 11. Stock markets have several exchanges. The two largest U.S. stock exchanges are the New York Stock Exchange and NASDAQ. Each exchange has its own set of rules and types of companies listed. 12. Stock indices track market performance. Indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite track the performance of a group of stocks, helping investors gauge the overall market trends. 13. The P/E ratio measures valuation. The price-to-earnings ratio is one of the most common metrics used to assess whether a stock is overvalued or undervalued by comparing its current price to its earnings per share. 14. EPS indicates profitability. Earnings per share is a key indicator of a company's profitability, representing the portion of the company's profit allocated to each outstanding share of stock. 15%. Stocks can be bought on margin. Margin investing allows you to borrow money from your broker to purchase more stock than you can afford with your own funds. While this amplifies potential gains, it also increases risks. 16%. Bear and bull markets impact stock prices. Bull markets are periods of rising stock prices, typically driven by optimism and economic growth. Bear markets are periods of falling prices, often driven by pessimism and economic downturns. 17. Stock split increases the number of shares. When a company splits its stock, it increases the number of shares in circulation, making the stock more affordable without changing its overall value. 18. Short selling allows betting on price declines. Short selling involves borrowing shares to sell at the current price, then buying them back later at a lower price. This strategy is used to profit from stock price declines but carries significant risk. 19. The stock market is not always efficient. The efficient market hypothesis suggests that stock prices always reflect all available information. However, many investors believe that markets can be inefficient, creating opportunities for profit. 20. Stock investing requires research. Successful stock investing requires thorough research, including evaluating a company's financial health, competitive position, and industry outlook. 21. Risk and return are correlated. Higher potential returns often come with higher risk. Investors should assess their risk tolerance before choosing stocks or investment strategies. 22. Buy and hold is a proven strategy. Historically, holding a well-diversified portfolio of stocks for the long term has outperformed trying to time the market with short-term trades. 23. Dollar cost averaging reduces timing risk. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach helps reduce the risk of buying at high prices and allows for a more disciplined investment strategy. 24. Sector rotation can be effective. Investing in different sectors of the economy at different times based on economic cycles can help you achieve better returns. 25. Understanding market cycles is key. The stock market goes through cycles of growth and contraction. Understanding these cycles helps investors make informed decisions about when to invest or pull back. Patience and knowledge of these cycles can lead to better long-term returns. Stock investing is an art and a science requiring discipline, research, and an understanding of key principles. By recognizing these 25 vital facts, you'll be better equipped to Make informed decisions, manage risk, and ultimately build wealth over time. Always remember that while investing offers significant potential, success comes from a strategic, patient, and informed approach. Attention. If you get value out of this book, please don't forget to drop your comments on this platform. Thanks for your support.